And we use Mortgage Supply Company an awful lot for our own personal funding, and also an awful lot for all of our clients as well. And he really is the man. He's the expert in this field. And 90% of tonight's presentation has been written by Dave, which is awesome, because those of you that have been on my webinars before will know that we don't recount any old webinars. We don't really do recordings of webinars. We only do live stuff, and we write all our own content from our own experience and knowledge. And so it's all fresh and brand new, and I think that's why we get such a massive turnout to our webinars. But that does take heaps of time. So, hats off to you, Dave, for pulling out some cool stuff for us tonight. I appreciate it.
Yeah, pleasure. Looking forward to it.
Awesome. So, who are Property Tutors? If you're brand spanking new to us as a brand or as a people, and I know there's about 160 people that registered tonight that aren't on our database, Property Tutors is a property coaching company. We teach our clients how to take on specific strategies in property investment, whether it be trading, renovating, development, buy and hold strategies. We do it in Auckland, we do it in Wellington, we do a little bit of stuff in Christchurch as well. We are very strong in the South Auckland market. We're very strong in the Lower Hutt Wellington market as well. I run Wellington, and my very close friend and business partner, Mr. Sean Wood, who most of you will know because he's a bit of a legend, to be fair, runs the Auckland and the South Auckland market. And I was just speaking to Dave Windler earlier and saying, hey, look, let's do a little bit of a market update about what's going on. And he made a very good point. He said that Sean and myself are sort of 6 weeks ahead of the market in a lot of respects, because we go to every open home, we go to every sale, we're at the grassroots, we're at the coalface, if you like, of the market at all times. And so we really do know where the market sits. The thing about Property Tutors and the way that we are set up, if you like, is that we're simply there to make our clients money. We get paid a fee to work with our clients if they wish to work with us. We don't take commissions, we don't take a cut, we don't take any of their clients' profits, and we simply work to make them money, which is a very ethical way to work, and it's also a very open and foreseeable and disclosed way to work as well. So you can't buy real estate off myself and Sean or any of the Property Tutors staff. We show you how to buy great properties. We don't buy them for you. We don't particularly recommend any one property over any other property for any other reason than that it might make money for our client. So I suppose that's a really quick cheat sheet of who we are and what we do. Now, I used to run around all over the countryside and do these seminars and talk to heaps of people, talk to all the property investors associations and all that type of thing. And now we do these webinars, and I find them really great because, I'm sitting here at the kitchen table in my house with a nice cold beverage next to me and talking to a few hundred people. And just if you're interested, we're talking tonight. We've got people on the line tonight from Kuala Lumpur, from Oxford in England, from Hong Kong, quite a few people from Singapore, some people from Portavilla, and quite a few professional rugby players actually out of France. We get a lot of that crowd listening in, and a lot of expats coming in to listen to these webinars just for a bit of an update, because they're not actually in the market all the time. They can't be here. And so, we've got people coming in from all over the place, including, I've just seen now, Kuwait City. So welcome there again. I hope some of you are up at sort of 4 or 5 in the morning with all that keenness of being overseas. Excellent. So I'm more than happy to answer virtually as many of your questions as I possibly can. So what I'm going to do is I'm going to largely hand over to Dave Windler shortly and let him present. I'm going to MC, and I'm going to read through your questions and ask them of Dave as and where I see fit, wherever they need to fit in. So come up with some amazing, awesome questions, and let's hit it from there. But firstly, I want to do just a really quick sort of, I suppose, a market update, if you like, of where I see the property market sitting right now, because it's moving, and it's moving nationwide. QV Online, who do valuations and have some very, very up-to-date stats and numbers, have come out with some interesting stuff just today. They've said that the Auckland property market has increased nearly 17% year on year. So Auckland property market's still absolutely through the roof. It's also 70% higher now than it was in the previous peak of 2007. Now, that's just astronomical. That's some huge money. But it has, in fact, in the last 3 months, decreased by 0.2%. Now, if you want to look at that in very real terms, what it basically means is that Auckland has been a rampant property market over the last 12 months, but just recently it slowed very, very slightly. But now I've spoken to a few people in the Auckland property market, one of them being one of the largest property traders in Auckland history, who does hundreds of trades a year. And his comment was, yeah, but there's a lot of people coming back into the Auckland property market now who've been sitting on their hands for the last couple of years, who are getting some astounding deals. And he feels that that's going to bring the market back again. He doesn't think it's actually terribly overheated, which is a big call, I know. Meanwhile, around the rest of the country, there's been two cities that have gone absolutely ballistic. One of them being Hamilton, and we're going to state the reasons for that very shortly. And the other one being my beautiful, stunning hometown here of Wellington City, which we've gone from putting in cheeky offers to putting in realistic offers. And if you know what a cheeky offer of mine looks like, you'll find that stunning, shocking even, because we don't do realistic. We're cheeky all over. And we've had to actually really up-spec our offers. And I mean, the average house, we're probably paying between $35,000 and $45,000 more now than we were at Christmas for exactly the same house. And we've had to upgrade our offers like that just to be competitive. And we're actually getting to a point now where we've got to be very quick to go and look at a property. Otherwise, it's going to become off the market before we get a chance to get to it. And that's, that's pretty scary for us. So we've really, really pepped up our prices. Have you been seeing that in the Auckland market, Dave? Because, I mean, you're at the coalface seeing all of the applications come through. Is this what you're seeing from your end?
Yeah, definitely picked up, from the beginning of March. But I think, Steve, the first 2 months of this year disappeared with the winter. And if you think about it, the kids didn't go back to school till nearly February. Then, up here we had Waitangi, then Auckland anniversary weekend, then you got a couple more weeks, and then you get Easter, and it's a lot of people have only switched their attention back to what they're really doing in recent sort of 6 to 7 weeks. But our volume spiked again in March, and looking at the pipeline and the activity and the amount of appointments the guys are having, I think it's busy times ahead again. January, February was reasonably quiet, but I think it's back on track again.
Yeah, no, I couldn't agree more. It didn't even stop or slow down. It just went a wee bit flat there in the middle, particularly in the Auckland market. And I think if you look at key performance indicators being availability of funds and cost of funds, I think that people took a wee pause when that 70% LVR restriction came in. And then I think that they looked at it again and went, hey, interest rates are actually still going down. And you can fix for a fair period of time with a Main Street bank for 4.5% now. And they suddenly woke up to, hey, that's pretty cool. Would you agree?
Yeah, it's no different to when the first round of LVR rules came in. During that year, first-time buyers were active. Prices started going up, and this time first-time buyers were to be blamed.
Yep.
The first round of rules came in. It went quiet just before Christmas. Early part of the following year was a little quiet. Everyone got used to the new rules and how to play with them.
Yep.
And it all went back on track again. It's no different to 2-3 years ago.
Yeah, no, I couldn't agree more. All right, well, look, we're sort of winding into it without the explanation, so to speak. So, Dave, can you explain how Mortgage Supply Company came about, a bit of the company history, where you've got people around the country,
Sure.
that, maybe introduce yourself and your company a little for us?
Yeah, no problem at all. So the Mortgage Supply Company was a rebranding of the original company that I founded close to nearly 10 years ago. We have a pretty strong base here in Auckland, team of 10 advisors. Also got good presence down there in Wellington, Palmerston, Kapiti, Waikato, and certainly in the year ahead we've got some really good advisors looking to join us moving forward. I guess what's our point of difference? Well, I mean, we probably do specialize in this area. For me in particular, what we're about to talk about tonight is right in my wheelhouse, and it's the sort of thing that gets me out of bed in the morning. We love dealing with investors. They tend to do good things with what we give them. And, you know, one of the things I will talk about tonight is, this byplay that takes place between good lending and good buying, and how the two things go hand in hand and help each other. And I'd like to think that we go the extra mile for our investor clients, and trying to make sure that we're listening to their goals and their aspirations, and we try and fit a lending strategy in to meet their requirements. And that's kind of the approach we have and how we look at it.
Yeah, no, I couldn't agree more, actually. And it's kind of, what I was covering with how I feel about mortgage supply as well. You specialise in this particular market, you can get funding for people, but you don't just throw any money at any person. There's a bit of thought that goes in, which I really appreciate. It's good. Cool. All right. So let's move along and get into it, shall we? What do you want to explain what these LVR rules actually are, and how they were brought about, and give us a bit of history and a bit of background on it, because I think that there's quite a few people out there maybe who think they know what this stuff is all about, but maybe don't have the clarity.
Yeah, sure. And it's worth just reminding ourselves of what the rules are. So it's a 70% LVR on Auckland residential investment property within the Auckland Council area. So if you're buying in Pocono, that's fine, but if you're buying in Sandringham, it's 70%. So
cool. So devil's advocate, what's an LVR?
Okay, loan to value ratio. So if I have a $100,000 property and I owe $80,000 on it, I have an 80% LVR.
Perfect. Cool.
And that's okay if it's my home, but it's not okay if it's an Auckland investment property. Not that you're going to buy much for $100,000, but it's an easy example. So that's an LVR. It's what you owe against the value of the property expressed as a percentage. So, the first lot of rules saw a limit of 10% on what was owner-occupied property then. So what it meant is that 10% of all the lending that our banks did could be over 80%. All right. So if you're a first-time buyer, you've got a limit to the accessibility of your funds. You have to be part of a pool that's only 10% of the total lending that the bank does, and that's what slowed things down at the first round of handbrake, if you like, from the Reserve Bank. That speed limit this time around was increased to 15% if you're out of Auckland. So it doesn't matter what you're buying or the purpose of your borrowing outside of the Auckland area, you can lend above 80% out of Auckland, even on an investment property.
Yep.
So that's another key shift as well, and that's certainly, I think, part of what is pushing some of these price rises regionally. It's not just investors that are looking at being able to lend 80%. It's once again first-time buyers who've got more accessibility to cheap money when they're buying their first home in the region. And that's been good for them too. And I think one of the things that's really important here for our long-term investors is part of the Reserve Bank requirements was that the banks had to put together let's call it a new asset class. And what that means is every time you borrow over a residential property, over an Auckland residential property, that loan's being tagged, if you like. It's been labelled. And it will make it easier in the future for the Reserve Bank to put in place further restrictions should they need to. So all these investment loans are now tagged and recorded and part of the reporting process that our banks have back to the Reserve Bank. There is a speed limit on these investment property loans in Auckland, but it's only a 5% speed limit. So, the banks can lend 5% of their total volume on a residential investment property in Auckland, but that speed limit is so low that there's no room for mistakes. So what they're doing basically is they're not doing it at all because they can't afford to break these rules. If they break these rules, their banking license is in jeopardy, and therefore they're basically not doing it at all. It only really allows them room to make the odd mistake. The important thing here is that the rules only apply to banks, and it has brought non-bank solutions into play. And then certainly that'll be one of the things we'll talk about tonight is, what are some of the workarounds here, and how can we use these non-bank options to keep moving forward. With probably touching on the exemptions. So new builds are exempt. So you buy off the plans, or you buy some land and build, you're exempt. You can lend beyond 70% if it's an investment property. The only rules that you're bound by are the bank's own rules. So, if you're buying a small apartment off the plans, you're unlikely to get 90% on it. But if you're buying a new build 3-4 bedroom brick and tile house, well, 90% is certainly one of your options, and it's definitely one of the workarounds. And refinances, so dollars for dollar refinances. If you refinance from one bank to another and that LVR happens to be above 70%, that's an exemption. And leaky homes. So let's say you had the misfortune to own a leaky home and you needed to borrow to remedy that property, that's exempt. So there's a couple of exemption examples there.
Now the banks, well, not the banks, I suppose, but the Reserve Bank and the people bringing these rules in have brought them in for a certain reason. And as I suppose a layman sitting watching it from Wellington, they seem to, by all accounts, have worked. So would you be of the mind to say that these are here to stay?
I think they will be for some time. I mean, if we think about those, the first round of rules that came in, potentially thoughts there was they'll only be in place for a while. Well, a couple of years down the track, and those first-time buyer rules, for want of a better word, they're still here.
Yeah.
And I think, we know that the turnover quietened down a little bit in Auckland, but it's starting to pick up again. And these rules were brought in combination with, let's say, changes to tax laws, which also had impact. The requirement for overseas borrowers to have an IRD number, the bright line test, meaning, you sell a property for any reason within 2 years, you're up for potential capital gains tax on it.
Yep.
And yet, things are still ticking along, and what's obviously happened is that people have directed their energies outside of Auckland, and property's still a hot topic. I can't see these rules going away for a while, so understanding them, working with them, understanding how to get the best out of them or around them becomes pretty important for those of you listening who want to keep growing.
Yeah, no, I fully agree. And I mean, I think a lot of people freaked out originally with the bright line test and went, "Oh, it's a new tax," but in reality, it's really not. It was always the rule was always there, and this is just a tightening or a mechanism to make people abide by that rule a little bit better. And I look at this restriction and go, "Well, it's not that actually that much different, really, is it?" And it really doesn't make that much of a change. It's just that there's a lot of investors out there that want to actively grow their portfolios and need to be able to access a better LVR, which means some sort of smarter lending, I suppose, doesn't it?
Yeah, smarter lending and smarter buying, I think, Steve. I think the two things go hand in hand. And we are talking about 10%. It's only 10%. And there are a variety of ways that we can go and find that 10% so that our investor clients can keep moving, and that's what it's all about.
Yeah, no, it's the only way to go. Cool. All right, go ahead.
All right. So this, it's a chicken and egg, and the reason why I've got that in there is that quite often when people come in and see us, they're trying to work out what their next move looks like, and we're obviously there to help that. But there's a little bit of a byplay that goes on between what you buy and what you've got. So, we can work out what your leverage looks like. We're going to talk about how to work out your available equity so that you can leverage. But, it's all relevant to what you need to buy. So what is your target property? Are you looking in Auckland or out of Auckland? Are you looking southwest, north, south, inner city? we work better when our clients have an understanding of what they would prefer to do next, okay? And it just becomes an easier target to hit rather than someone coming in and go, lend me some money because I want to buy something. So, one of the things I want to talk to everyone tonight about is, having a think about your own strategy and have a think about what you want your next move to look like and what does it need to be. We're not going to overly talk about income. We're going to make an assumption here that if we're dealing with the banks, that you've got the income that's going to make the lending work. This is kind of talking about manipulating the equity or manipulating the LVR a little bit so that we can find that 10%, okay? And, if you go to the next slide for me, Steve, when we talk about working with clients who know what they're doing, everyone's going to be at various stages of experience, but, there's some key questions that you can start to kind of ask yourself, and that is going to give us some direction as to how best can we lend to you. For example, the question there, am I strong in income or am I strong in equity? If you're strong in income, if the income math is really good, then, you can afford to buy something perhaps that's not so much used very strongly. But if you're low in equity, so we haven't got a lot of leverage to start with, it becomes really critical that you buy stuff that's got equity in it, or that you buy stuff that you can add value and create some equity. Otherwise, you'll make the next purchase, but you won't be buying another one for quite some time. And when we sit down with our clients and look at what the next move might look like, we also start to give our clients some feedback about what the next 2 or 3 moves might look like. And we can only come at it from a lending point of view. We can't advise you as to what to buy. But if I'm suggesting to someone that, their equity is really tight and they can only buy one property with the equity they've got, it kind of makes sense that they've got to go and buy themselves some equity so they can keep going. Start to have a think about what your strategy looks like, because a good mortgage broker, a good advisor will lend to you so much better and keep you going.
So basically what you're saying is the same thing that Sean and I have been harping on for years about, is that investing and buying a house is all about having a balanced portfolio, making sure that your income keeps up with your equity and vice versa, and then, you're in pretty good stead then, really, aren't you? Yeah,
of course. I mean, and the only time that folk get into trouble is when income becomes an issue. So property prices will always rise and fall, and we know over the long haul they keep on going up. But buying stuff that cash flows is really critical, I think. So it's really important, outside of knowing your strategy, that you kind of, know your numbers and, start to take a look at your own properties and understand them. Understand what they're worth. So the value of what you've got right now is critical, because that's the key number that we're going to work out what your leverage is. So you take that value. So let's say you have a $500,000 property, then we want to take a look at 80% of that if that's your home. So you can go to 80% on your home, or you can go to 80% on an investment property out of Auckland. And if you take 80% and subtract what you owe on it, the bit that you've got left is your use. So if I have a $500,000 property, it's my home, I can go to $400K on that property. It's 80%. And if I owe $200,000, then I've got $200,000 worth of usable equity. And that's what you've got there to leverage. And that's when we start to take a look at, okay, well, what can $200,000 of equity get me? Can it buy me a couple of houses in Wellington? Does it get me one in Auckland? Well, it might not get you one in Auckland if your target is a $700K property, because you haven't got 30%. And that's when it starts to direct you to different properties and different locations. So this is where, we've got this interaction between what you can do from a finance point of view with what you want to do with your own investment strategy. And those two things start to play against each other. Next slide is just a little bit of an example. There's just 3 examples there. So, in Auckland, if you've got your home valued at $1 million, you owe $500 on it, you're allowed an 80% LVR, and we've got some usable equity there of $300. We might have an existing rental property, 70% LVR because it's in Auckland. There's a little bit of equity there. And we might have recently gone down State Highway 1 and picked up one in Hamilton. We are allowed 80% on it, but in that example, we've got no usable equity there. So there's just 3 different LVR samples and how you can go about calculating your usable equity. Now, once we've worked that out, it's just sitting there on paper. It's no good sitting on paper. We've got to get it out, and we've got to get it out as a loan. And normally, our course of action is to get that equity out with a revolving credit facility, a flexi. And this is where people face their first roadblock. Because to get your equity out in a revolving credit facility, you've got to have the income to get it out. It's a loan, all right? And the bank will look at it on the basis, sure, you've got $390,000 of usable equity, but we're not going to give it out to you because you don't have enough income to pay us back, or you haven't given us a good enough reason why you want it. And sometimes, they just don't get it. And the income piece is normally the key roadblock, because while every single bank will calculate LVR in exactly the same way, they all calculate your ability to borrow through income in wildly different ways. So you might have a property with $200K of equity in it, the mortgage is with ANZ, you go to ANZ, you want to get the equity out, and they say you can't afford to. Well, ANZ happens to be one of the hardest banks to get a flexi facility out of, and their income calculations are a lot harsher than 90% of the others. So if you're an ANZ customer, you go to them direct, they say no, you give up. You think, well, if they're not going to do it, if my bank's not going to do it, none of these other banks are going to do it, and you stop. Well, what the reality is, a change of provider and a change to a different set of calculations that you don't know about, but we do, would see you getting that equity out and, making the step to the next purchase. And probably a massive part of what we do for our clients is unlock equity, shift the numbers around, work with the right banks. We get a massive amount of value out of the smaller New Zealand banks, TSB, SBS Cooperative. We actually probably in combination do about 20% of our volume with those banks, which is extraordinarily high. But they just give us great outcomes, and they're very good to deal with. And then, sometimes you actually take a look at the value of your properties, and it's just not giving you enough. And that's when we've got to either shift our target from I want to buy in Auckland to I want to buy out of Auckland, or in fact, the other thing we've got to do is shift the numbers. And there's a few ways that you can shift the numbers, and you've got to understand how banks go about valuing property. And if you give us the next slide, please, Steve.
I think also there, Dave, you've also got to look at it and go, is your portfolio balanced nicely? And is there sort of assets there that aren't doing you any favours, you know what I mean? And possibly even look at selling one so you can buy 2 more sometimes.
Yeah, I mean, I think, for us as registered financial advisors and mortgages, we're not going to sit down with the client and say, you've got to sell that in order to do this. Because it's just something we're not allowed to do. But once you start taking a look at the numbers with the client, it becomes something that they actually kind of work out for themselves. And sometimes you've got to take a step backwards to take 2 steps forwards.
Yep.
So, how are you measuring the value of the properties? One of the things that, varies wildly when we sit down and talk to investor clients is they can be way off the mark with what they think a property is worth. They're sitting there thinking that they've only got 100K of equity across a couple of properties, but we measure the value differently. And all of a sudden it's like, oh wow, the equity is there. And look, CV, not worth the paper it's written on in terms of valuing the property. Banks will use CV, there's no problem with that, but it's just way off the mark. And the quickest and easiest way to get a reasonable indicator of what your property is worth is to use an eValuer. Go to qb.co.nz. It's $49.95, I think, Stephen. And the reason why I direct you to perhaps look at that is what's important about that valuation is that it's cheap and cost effective, but most importantly, the banks will use it. So the banks will use that and they will lend you 70 or 80% against that value once you have it. So it can give you a very quick and easy measurement of how the banks will look at your properties and how they'll value it, and therefore how they might look at what your leverage is. And the key there with those eValuers is they sometimes can be a little bit off the mark. And if they are compared to what your own opinion is, then you've got to default to, spending $600-700 and getting a registered valuation done. But the eValuer is an extremely quick and easy way to measure where your leverage might be.
Yeah, I'll tell you, there's actually one more too that we've played around with lately, and it's going nationwide very shortly, and it's getting bigger and bigger. And once again, it's not the world's most accurate way to go, but they use comparable sales and give you some good ideas, and that's one I found that's called homes.co.nz. It's largely Wellington-based only at the moment, but rolling out through the rest of the country is probably something worth bookmarking for everybody online tonight. So that's homes.co.nz. I've just sent it to everybody in a chat message as part of the software here as well. So keep an eye on that too.
Yeah, good. Yeah. Well, there's 2 main data providers in this property space. It's CoreLogic and Data Insight. And this is where, on the old Trade Me property app these days, you've got the comparable sales data available in that app. And they're all using the same data in different ways. So QB is part of the CoreLogic stable.
Yep. And
you can also use the Data Insight version, which is called an iValuer, and they'll come up with similar numbers. QB is used by more banks at the moment, so that's why I've directed you to this one. And once again, gives you a really good indication. It's backed by data. Most important thing, banks will use it.
Yeah, for sure.
And then you might be sitting in properties in your portfolio that, on paper are worth, what you think they are, but they've probably got the ability to be worth a bit more. And, if you're a bit short on equity to make that next step forward, but you've got the desire to do it, then maybe you've got to do something about what you already own and add some value to it by renovating, subdividing, minor dwelling, whatever it might be, to create the usable equity that you need to move forward. So have a think about that, with properties that you currently own. And the next step beyond that is what I call forward leverage. And you've got to look to, if you're short on equity, if you're short on leverage, but we can get you into the next property, or that property's got to add some equity to the mix, in order to keep you moving forward. Right, well, hopefully you're not asleep and you're just taking a breather, but it's just worth just taking stock of what we've talked about here. So, hopefully you've got some better idea now of what you have, and and are starting to think about what you want to buy. Now, our role at this stage is to kind of fill the gap. You know, our job's to remove the roadblock, help you leverage what you've got, and then finish the job off with some balanced funding that will, you know, make that next acquisition take place. But before you get to that stage, you know, it's just worth, just taking a look at what you've got, having a look at your own numbers, and starting to get a little bit of a feel for where your equity might be. And the next step then is definitely to work with a decent mortgage advisor, because our job's to remove the roadblocks and make sure you're dealing with the right banks to help you get that equity out. And the next bit, we're going to talk about some of these bank and non-bank options when you're looking to make that next purchase. And, you know, if all the numbers are good, then we're going to bank it. You know, we're always going to provide the best option, and banking it's always going to be, you know, for buy and holds in particular, you know, the way to go, because the interest rates are so good. It's going to give you a chance to cash flow the property. But, you know, you've got to make sure you deal with the right banks, because they're all different. And you know what? There's no point if you've got heaps of resources, so you've got good income and good equity, you're going to run out of one or other of them at some point. And trust me, you know, delivered the same set of numbers, I can go and get 6 or 7 different outcomes from 6 or 7 different banks. And if you're an active, progressive, I want to buy some more property kind of investor, then you've got to deal with the banks that are going to make your resources last longer. So they're going to make your equity last longer, or they're going to make your income last longer, because simply by dealing with the right bank, you may be able to buy 1 or 2 properties more than if you're dealing with the wrong bank. So your choice of supplier is crucial, and don't put all your eggs in one basket. We 100% all of the time, if you've got your home with Bank A, your investment properties must be with Bank B. Because if you do all your business with Bank A, they'll cross-securitize all of your properties and cross-securitize your rental properties with your home, and it becomes a lot easier, a lot more difficult, to keep moving. It becomes harder to unlock the properties should you sell one. And if that bank says no, then it's you know, pretty hard to keep moving forwards. We encourage our clients to deal with, you know, 2 or 3 different banks, and that just makes it a lot easier and more flexible to keep moving forwards. And when we're dealing with the banks, income becomes a critical factor. Pick the right banks, it's important. Alrighty, let's look at the other side of the fence. And, you know, I'm talking about Resimac here, and I've called them a near bank because they are the closest sort of to a bank. They've got a range of products, and their prime product requires the same kind of hoops to jump through as a bank does. But the critical difference here is that they become a really good option if you're short on deposit. So they can go to 90% on an Auckland residential investment property. Now that's a huge gap. If you're talking about a 700K purchase, you can get in there on 70K deposit as opposed to 210K. They'll do interest only at that level. The rates are higher. And I say, does it matter? Of course it matters. But if that's the only option that you've got because you've only got, you know, a 10% deposit, then all you've got to do is weigh up the cash flow because of the higher rates. And is that better than not being able to buy at all? So they're a really good option. Strong lender. They've been in Australia for 28 years. They've had a presence here in New Zealand for 2 or 3 years now. Really strongly backed organisation. Good to deal with. Really good option. And it can make your equity spin out quite a long way. So definitely an option for the buy and hold. Something we did quite a bit of recently is is looking to a non-bank lending environment. We call them asset lenders because they care about the security more than the income piece. But they're a short-term funder. They can go to 80% on an Auckland residential investment property. So what we've done with a few of our clients is we've bought a property at 80%. So we've gone in with a 20% deposit. The 10% that we haven't had to put in as deposit becomes the money that we can add the value with. So instead of having to put 30% in and that's it, we bought it, that's great, but that's it. We've now run out of deposit. But if we can just put 20% in and we can hold some money back to add value to the property, because it's that sort of property, we can do a good reno, we can add a minor dwelling, whatever it is. Good investors will have an understanding of, if I buy a property for 500K and I spend 50K on it, I know, because I'm an expert in that area, that when I've finished the job, it's going to be worth 700. So can I bank it after that? So the idea here is you take a look at your beginning product, understand what the end product might look like, and if you can bank the end product because you can create 30%, then we use a short-term funder, allow the property to be purchased, give you enough left over to renovate, and then you take it back to bank at the end. Job done. And that's worked really well on a few deals where the client bought it really well, and there's been some real value to be gained by doing an absolute quality renovation, and we've moved it back to the bank because at that stage the tenant's moving in because the whole renovation's been done and the cash flow is better as a long-term hold. And there's been some beauties. We've done half a dozen this side of Christmas that have worked really well.
You know, that's exactly what you've done for me on the latest one that I've done, eh?
Yeah, sometimes it's just a lot better way to go. You know, if there's a big gap between your purchase price and the end value once you've renovated, you're far better off to settle with a non-bank lender and take it out to a bank later.
Yep. Yeah, it's viable, but I mean, I've got a lot of questions coming in about what sort of interest rate increase are we talking here. I mean, if you've got really awesome interest rates coming out of main banks, what are these asset lenders and Resimax charging? What sort of ballpark are we at?
Well, Resimax tier their interest rate based on the LVR. So, you know, even if we look at an 80% LVR, their 2-year fixed rate's 5.29%.
Yeah,
so it's a 1% difference.
It's
not. And if it's the difference between being able to buy and not buy, it's got to be worth a look.
Yep.
The asset lender costs are always going to be a little bit higher, and quite often there's a fee component in the mix. But when you're buying a property and maybe creating a couple of $100K of difference in value between what you buy it for and what it's worth when you're finished, it's a relatively small cost of doing business. But it would always become something that we would factor into the exercise and make sure it's worth it.
All right, so what else have we got?
Well, I think, from the funding side of it, we've talked a lot of about, what can we do to work around the Auckland market. But, once you start looking at it, and buying out of Auckland starts to become attractive. And, we've certainly had a large number of our clients look out of Auckland. Yields in certain places are pretty good, and they're just spinning their money around a bit further because the purchase price is lower, and they only need the 20%. Whether there's capital gain or not to be had, if it's short-term or long-term capital gain, all the crystal balls are broken. And I think the key thing for Auckland investors is where, that they've gone from Hamilton, Tauranga, to Whangarei, to Wellington, maybe dealing in marketplaces that they're not an expert in. And it's not as easy a decision. And I think also, stock's not so easy to find now. So we're finding now some of them are coming back to Auckland and having another look at this marketplace. I don't know what you're seeing down in Wellington, Steve, at the moment.
Oh, we're seeing a lot of Aucklanders in the Wellington market right at the moment. I think a lot of smart money stayed in Auckland for the last sort of 4 or 5 or 6 years, and they made a lot of money in the Auckland market. And they're now looking at it and going, well, if they're going to bring these sort of speed restrictions in, I suppose, with the LVR, it's probably worthwhile spreading it around a little bit. I think Hamilton and Tauranga straight away went to an unaffordable level for people's expectations of value. And now people are looking at Wellington for exactly the reasons that I've been harping on about Wellington for the last couple of years. We've been flat for 7 or 8 years, no value increases. We've got great job security, great average income, and for the price you pay for one decent house in Auckland, you can buy 2 houses in Wellington. The latest figures show that Christchurch isn't as popular. I think people have started to realise a little bit how long it's going to take for Christchurch to get back to some sort of level of normality. And I think that anything smaller than that comes quickly off the radar for serious property investors. And I know Matt Gilligan from GRA agrees with me on this, that anything smaller than the 4 or 5 main centres in New Zealand isn't a terribly viable option at this point in the market, you know?
Yeah, I think, I'd agree with that. But, we kind of are certainly getting, a lot of our clients in the last 6 months have done Hamilton, done Tauranga. That's now gone quiet. Some of them are looking at Whangarei, interestingly enough. Similar distance north as it is to Hamilton south. And some are hopping on a cheap Jetstar flight and taking a good look in your neck of the woods. And actually some of them now are also looking at apartments in Auckland. The price point of an apartment has become a bit attractive to them as well. So we're getting a number of our clients looking quite hard in the Auckland apartment market. So it'd be interesting to see where some of our listeners have been buying recently. Be quite interested to get some of your feedback, guys, are out there. That if you've bought out of Auckland over the last 6 months, it'd be interesting to see where you bought.
Yeah, well, let's do that. Let's have a quick poll. Chuck into the questions section there the last place you bought a rental property. There's 249 people online right at this very moment. Last place I bought one was Upper Hutt. Let's go. Hamilton, Auckland, Hamilton, Whangarei, Hastings, Churton Park and Wellington. We represent Rotorua, Hamilton, Mangere, Auckland apartment market, Auckland, Christchurch, Auckland. Just bought in Rota Vegas, Hamilton, Palmerston, Hawke's Bay, Auckland, Lower Hutt, Hamilton, Lower Hutt, Whangarei, Auckland, Hamilton, Christchurch, Wanaka, Upper Hutt. Yes, a lot of out of Auckland stuff. Considering that the demographic for this webinar tonight was pitched squarely at a problem that in fact affects Auckland investors pretty much uniquely. There's a lot of outside of Auckland investment going on there. Auckland, Wellington, Wanaka, Auckland, Wellington, Auckland, Dunedin. Yeah, it's big mixed bag. How unscientific was that? But interesting still.
It was pretty unscientific, but I think the feedback you just got there matches what the team here is experiencing, and there's a spread of the money outside of the region, and it'll be interesting to see if it starts coming back again. Are the provincial centres going to go through the same that maybe investors think about Auckland? At some point, they're going to go, actually, that now no longer represents enough value for me to buy there. And what does that look like? Because I guess the whole thing with Auckland is these prices go up, to an unreal levels, is we're still looking at Auckland as our biggest centre, our biggest city, and more likely to cope with this than any other place.
But more growth and more sustainable growth. I mean, you've got to look at it too, and you've got to look at the people that went for cash flow at the end of the last boom, and they bought in Manaia, and they bought in Hawera, and they bought in Invercargill, and they bought in Palmerston North, and then the market moved and went back down to the pre-2007 peak prices, and they all,
Yep.
you know, the tide goes out. The saying, what is it? What's the saying? The tide goes out, and everybody sees who's wearing a swimsuit and who's not. You know what I mean? And I think that people will invest outside of Auckland, and they'll invest there for the stability of some larger centres that are getting some capital gain for the next few years, like Wellington, like Dunedin, like Rotorua, Whangarei. But they won't go to too many smaller places than that. And when they do make money in those places, they'll either sell or they'll refinance, and they'll put the predominant majority of their investment funds back into that Auckland market again, because it's close to home, it's what they know, and and all that type of thing. It doesn't make it right or wrong. I just think that it's going to be the habit, the way that it goes. But I think that certainly buying outside of Auckland at the moment is more than viable. It's just a sensible move, particularly now that Auckland's flattened a little and everywhere else is starting to pick up really nicely. I think that it's inevitable if you take the wind out of the Auckland sails. Oh, you got to hate the analogy there. That was terrible. If you take that wind out of the Auckland sails a little, it's going to puff up the rest of the country. You know what I mean? The money's going to flow down to some of the other centres, and I think that's just what we're seeing. But I mean, as you say, buying out of Auckland is hugely viable.
Yeah, and I think what we're trying to do with the things we've talked about tonight is try and open up the numbers so that the folk listening kind of think about their choices. So it sometimes it's pretty easy just to kind of default to what everyone else has been doing for the last 6 months. Yeah, so you look at your position and you think, I haven't got enough equity, or Auckland's too expensive, I'm going out of town. Where if you actually stopped and thought about your investment strategy and what the end game needs to look at, you might still decide that Auckland's the right marketplace. And if that's the case, well, where do we go about making these numbers work best for you? Where do we go and find this extra 10%? What are some of the funding options that you might not have looked to before that we can put into place to make this next purchase happen? And I mean, outside of the funding thing, and I think we perhaps go to the next slide, Steve, is just to maybe throw some thoughts around between the two of us on this last slide, is that, sometimes if you can't do it on your own, you've got to do it with someone else. Yeah, sometimes you've got to get by with a little help from a friend. And, so we're sometimes dealing with clients now that are teaming up with somebody else to make an investment happen. And because I think the thing with the LVR rules is that it's going to slow down the newer investor. So those of you listening who have bought property over, the last 4, 5, 6 years will probably not be overly worrying about the LVR rule changes, because you've probably got the equity across your portfolio to keep going. But if you can imagine you are a younger couple, you bought your first home 5 years ago, you've seen some fantastic capital gain in it, but because of the LVR rules, you actually can't make this next step up into being a newbie landlord. And I think they're the ones that are going to, be held back a little bit. But some of them are now teaming up with someone else in the same position, and they're joining their equity positions together to leverage and buy a property in partnership. And that can be pretty straightforwardly put together from both a lending and legal point of view. We try and tie both sides of it together. So we're talking to some younger property investors who are doing it collaboratively, and also sometimes the gap's only a small one, and parental help, supporting security from mum and dad are still options that can be utilized as long as they're done properly and safely and in the right way. You can start to kind of fill the gaps, a little bit of polyfiller here and there, just to make the thing work. Because once again, if you're using these methods, what becomes, I think, critically important is what you then buy. Because if you need a bit of a lift to make the purchase take place, as in, the bank of mum and dad give you 30K because you're a little short on the deposit, becomes pretty important that you buy something that you can add some value to, so that you can lift the value of what you buy and then give bank of mum and dad their money back. So we try and make sure that we're, bringing both those ends together. So whatever it takes to get across the line, we're okay with that, but we're looking at it as a short-term thing, So, and that normally means buying something that's got some growth in it, some equity, or some add value can take place.
And to be fair, within Property Tutors, within these groups that we run, we do an awful lot of those last four options there. With when you think of trading within ourselves, joint ventures, equity support, cash loans, gifts amongst investors, and that last one there, I've just done a fairly stunning deal myself, which is just coming to completion right now, and it was not a deal until the vendor finance portion of it came through, and just an outstanding deal that I couldn't have touched otherwise. To give you guys online tonight an idea, it was a property I bought for $500,000, and 3 months into the renovation, I've spent $55,000 on the renovation and just refinanced, well, actually revalued the property and about to get Dave here to refinance it for me, and it's valued up at $1.4 million post-renovation. So I've obviously got photos of that and floor plans, and I'm going to do a big explanation of it in the Auckland and Wellington Masters event and just point out exactly how that's done as well. So, there's still some stunning deals to be had out there, and sometimes it's the way that you put the deal together that makes it most profitable.
And makes it easier to finance. I mean, I think that's where there's this interplay between, what you buy, how much you know about what you're trying to do, and the finance options that can help you make these things happen,
Absolutely. Now, I've heard a couple of questions rolling through here, and I just want to cover a couple of things just quickly.
Sure.
I've been accused as a one-eyed Hurricane supporter, Wellingtonian, of being anti-Auckland in some of my comments. I'd like to clarify, we run coaching programs, obviously, and we work with a couple of hundred property investors at any one time. And I suppose my clarification about whether I'm Auckland bashing too badly or not comes down to the fact that by far at the moment, our biggest profits that our clients are making are still in the Auckland, or the South Auckland rather, property market. And, we've got clients making $1 million a year in property trading. We've got clients making between sort of $50,000 and $100,000 per property, and then doing a couple of those properties every month in the South Auckland market as well. Don't for any reach of the imagination think that Auckland is anywhere near over, and in fact we've seen a lot of investors getting back into the Auckland market even with these LVR restrictions, just for the fact that properties seem to have paused slightly, and you can actually get stuck into some really grass deals for actually not as much money as you thought you could or would have to previously. So it's there's money to be made in this market all over. And I think the most important part is the fact that this market isn't going away very quickly. It's not changing incredibly fast at the moment. There's about 10 factors that make it good for us, including easy ability to get funding and low interest rates, and the fact that the market's actually quite readable right now, that make it just a great market to get into. So, don't by any means be scared off by it anywhere in the country. Retract any negative thoughts about Auckland altogether. Fair call. I bet Dave knows exactly who gave the bash on that.
Just throw a quick thought in there. What's happened in the Auckland marketplace is so similar to what happened when these first round of LVR rules came in, right? So, first time buyers came in strong, prices went up, LVR rules came in, they went quiet, and there was about a 5-month period where it was less busy than it had been. It's like someone had pressed pause on the property remote. But what happened then is, instead of pressing play, they went straight to pressing fast forward.
Yeah,
so, if we've had a little pause, I don't know, it's starting to build up again, and it'll be very interesting over the next 3 or 4 months what the property data says. My feeling is it's going to go pretty busy for the rest of the year. It's just starting to feel that way, having gone through it before.
And I mean, to be fair, those listeners who've been on a few webinars with me would have heard me preach on about what's happening in the property market over the last few years from different webinars. And you'd be quite right in thinking that I'm actually, and in fact, never ever wrong about anything, to be fair. And I said that, hey, look, you've got an LVR restriction and it's going to be a hiccup and then the market comes back. You've got in 2007, you had 10% interest rates, and it was a little hiccup, and the market came back. And you can roll right back to the introduction to GST and go, there was a little hiccup in the market, and it came back. And it does this because of the fundamentals involved. And the fundamentals are there is not enough houses in this country for the number of people who want to own them or want to have one. And we're 50% down on listings in Wellington than where we are normally. So we've got half the number of properties, but the demand always keeps surging ahead behind it. And it's exactly the same thing in Auckland. Immigration's at very similar numbers to where it was in the peak of 2006-07. Except now we've got this LVR restriction. Yeah, well, sure, but we've also got 4.5% interest rates as opposed to 9%. And so it doesn't take a scientist to realise that your rent doesn't have to be going through the roof to support it, because owning the property is costing you less because the cost of getting the money is lower. Now, I could spend all night on a whiteboard sort of explaining that one, but trust me, I don't think anything drastic is going to happen to the property market in the next couple of years. And in fact, in certain locations, including my beloved Wellington, I think it's going to go very, very nicely over the next couple of years. All right, rant over. Back to you, Mr. Windler. How can you help us?
Yeah, well, I think obviously, we're here to play a role for our investor clients, and I think the bottom point's the most important one. For us, the most important thing we can do is make your next purchase possible, and there's so many different ways that we can do that. Everyone's numbers are different, and hopefully tonight all we've done is provoke a little bit of thinking for those of you who feel that you might be locked, your equity's locked, or it's trapped. Can we help you get it out, or you don't think you've got enough of it to buy what you want to buy? So, more than happy to work with you on that. And I think, as we head towards, I think probably Steve, you've already mentioned a couple of pretty reasonably informative days that we've got coming up. There'll be more of this information that we'll be looking to impart then.
Yeah, absolutely. And I mean, we've got our Masters campaigns coming up. You see at the bottom of the screen, they're actually May the 1st in Auckland and 15th in Wellington. And we throw you up on the stage for an hour as well. Sean Wood and myself talk for ages about where we've come from, where we see things. But I think in most cases, the most interesting part of coming along to our Masters event for a lot of people is the fact that all of the crew members around the room that help out on the day are actually current clients of ours and are actually doing real live deals and lots of them in the marketplace that you guys online tonight are wanting to be in as well. And also, we put them up on stage, give them a microphone and say, hey, look, you guys ask them some questions. You ask them what they're doing and how they're doing it. That can be really, really, really useful. And I mean, those events are coming up, as I said, very, very shortly. Sean Wood and myself are really looking forward to them, as we always do. They're a great fun event. But the flip side of the fun side, I suppose, of it is the fact that Sean and myself are self-made property people. We've been in this market for years and years, doing our own stuff and our own portfolios, and we both got asked by people we know to come along and help them out with their portfolios. And it just starts, simply enough with, hey, can you come and can I buy you a coffee and pick your brain? And that for Sean and I has turned into what constitutes pretty much a full-time job. I know that it's heavily impacted on Sean's golf, which is really sad. He was a pretty fierce sort of a golfer, to be fair, and now he's actually working way too much for a living. He's actually had a false start in retirement a couple of times, and he's got to a point, particularly in the South Auckland market or the Auckland market altogether, really, where he's just a bit of a soothsayer. He's a messiah with the numbers and the detail in that marketplace. And I'd like to say that I'm pretty close to that in the Wellington market myself. We know our markets in depth incredibly well, and we've just been able to create a situation whereby we can assist a large number of investors to make huge amounts of money in the property market in New Zealand currently. And I've been saying it for a couple of years, saying, hey, the good times are absolutely here in Auckland and are coming for the rest of the country. And I truly believe that that's the case right now. I think that now is an amazing time to get into this marketplace, simply for the fact that that rents are stable. It's easy to get your hands on money, and this market is actually pretty readable. It's not random and it's not strange and weird and wonderful. And so now is just such a unique time to look into it. So we've rewritten pretty much a huge amount of our Property Masters event for this year, just based on the fact that the market's moved and changed and it's a bit fresh and new. And so we want to invite as many people on the webinar tonight to grab a ticket and come along and listen to us tell you how we made our money, how you can make great money in this property market as well, and to just grab some great knowledge and some great information. But as I said previously, and this photo shows you what we do, we give some of our great clients and get them to sit on stage and hand them a microphone, hand you a microphone, and you just can ask some questions. And we're talking, there's some people in the lineup on stage there who do 15, 16, 18 property transactions a year. We've got people on stage there that do 5 or 6 a month. And I mean, Dave, you tell me, because you're the broker for a lot of these clients. You'll know a lot of the faces on stage on that photo there. You see what they buy
Yep.
these properties for, and then what they sell them for, and the sort of size of profits. Can you comment on that at all?
Yeah, I mean, I think there's looking at the people on stage, there's one or two of them that have done extremely well, and from pretty small beginnings. I think that's the key thing about this, is that the vast majority of the clients that I collaboratively work with you and Sean on is that it's pretty normal people who are just quite happy to work hard and work smart. And you know, both in Auckland and Wellington, those that are doing some trading, you know, making some good margin, but they're also happy to hold along the way. So, you know, we're still working with clients in Auckland here, you know, who are getting good yield on properties, and when they find those, they keep them. So there's a lot of activity, and there's some good deals taking place right now.
Yeah, I think there really is. And I think that, you know, we get accused maybe of puffing this market up sometimes, and we're really not doing it. I mean, I'm looking at those people on stage, and I can't see, you know, I don't think there's many people in that photo alone that aren't millionaires and have become that way in the last couple of years from the stuff that we're teaching and the stuff that we've shown them. There's just some outstanding stuff going on in the marketplace, and you've absolutely got to be into it. It's magic. So we're going to throw an offer at you guys tonight to grab a ticket, come along to the Masters event with us, and it's the simplest and easiest way we can make it work for you. So for the next hour, or until we sell out of tickets, we possibly won't sell out. We have done in the past. For first webinar, we've just gone bang, and it's just gone bonkers. I know we've got a couple of hundred ticket sales for the Auckland event already, but here's the offer we're going to make. You can come to our full event, the Property Masters event, for $9.90. Now that's just not one ticket, that's 2 tickets as well. I hate to do the Ginzu steak knife rubbish, but hey, that means that you can bring 2 people along, which means that you can come along with your life partner or husband, wife, business partner. A lot of the time in the past, we've had a parent bring a teenage kid along to explain to them how to make money in property as well. Bring somebody with you. Bring 2 people along. $9.90, you can't go wrong. To be fair, if we don't grab you and make it interesting and you're not enthralled in the first hour or two of the event, then sneak away at lunch, do a runner. Because seriously, we've got some interesting stuff in these events. I rave about them. I think they're bloody great. I really do. And I think that you should absolutely get along. If you're online tonight, then this is the stuff you need to be knowing, and you need to be learning about the property market from the people that are doing it. So what you need to do is go to bookthedeal.co.nz, and for the next 60 minutes, what is it? It's 8:43. So 9:43, we're going to turn this off. We can't afford to sell too many of these tickets at $9.90. You know, it's a token effort just to get your get you on board and grab you a ticket, get you along to the event because you've taken the effort to be on the webinar tonight. Hope we've added some good value for you. But there you go. It's bookthedeal.co.nz. It's $9.90 to grab a double ticket tonight. And those are the Auckland event, which is Sunday the 1st of May. That's at the very, very lovely Langham Hotel in central Auckland. There's loads of parking. It's a 9 through 7 event. And then a couple of weeks later on the 15th of May, middle of May, it's the Property Masters event in Wellington. That's at the Intercontinental Hotel. And once again, loads of parking there too. And once again, it's a 9 a.m. through 7 p.m. event. So registration opens at 8:30 in the morning. Bowl up, bring a notepad, be ready for a really mind-expanding day. We're going to show you some stuff that's really going to rock your socks off. So be prepared. These are a really, really grouse event. Have a look at our Facebook fan page for a few reviews from people walking out of the event saying, hey, look, this really changed my life. And, I've done a few of these webinars now. I've done a couple of these events too. And to be fair, come along, get the information. It's virtually free. And have a listen to what it is that we're saying and why we're saying it. Talk to some of the crew that are there that are saying to you, hey, look, we took this advice a couple of years ago and we're now financially free and independent. And hey, I'm asking for less than $10 from you guys. Unless there's something very wrong with my offering, I think that you should be diving on this with both feet. So we're going to leave that open for 60 minutes. And what I'm going to actually do is hit some of these questions for you, if you like. Before I do that, I'm just going to make sure that Dave is still there with me. I'm going to throw some questions at him, and you can bang through any questions you like. First question I've got here is, so do you think the Wellington prices will continue to rise? Yeah, I actually do. I think we've got a couple of years yet in Wellington recovery, if you like. I don't think we've got a boom or a bubble whatsoever. I just think Wellington's recovering from 7 or 8 years of flat no growth. So, yeah, I do think we've got some time to go there as well. That's that question. Dave, question for you. Can you clarify the requirements of an owner-occupied property? What are the workarounds and how long does it need to be owner-occupied for?
So we're talking about, so when we say workarounds there, so let's say what 80% LVR is what you can safely go to without falling foul of any bank requirements. And if you're let's say first home buyer and you're putting your Kiwi saver into a home, you've got to live in it for 6 months. But who's going to go knocking on the door to make sure you're there? But I think you've got to be a little bit careful if you're looking to avoid the LVR restrictions by living in a place and then sort of moving on. But I think that if you're at 80%, when you buy it and you decide afterwards that, well, gee, I'm going to move on, well, circumstances do change, and I don't think there's going to be much comeback to you, to be honest.
Yep. No, I couldn't agree more. I think it's more about being in the market now than much else, to be fair. And you're going to cover the stuff at the event as well anyway, aren't you? You're going to get right into the different types of investors and how they get their funds anyway.
Yeah, definitely. I think, we look to my presentation at the Masters event, we're really looking to try and give the audience all of the options. Everyone, there'll be 400 or 500 people there. They'll all have different circumstances. So a big part of what I try and do is make my presentation relevant to everybody in the room. So there'll be some strategies we'll introduce at the event that will really spark off some thinking. And what we're trying to do is go, okay, look, if we can use the right funders, we can hopefully give people an I can do attitude. Because half of the roadblock really, we did roadblocks earlier and we talked about the funding roadblocks, but to be honest, the main roadblocks is someone actually making the decision to take action. It's one of the things that we look to do on the day is trying to, find all these reasons why people potentially can take action,
Yeah, absolutely. I've just had a text come through from the back end from Phil talking as well, and he says 22 people have just bought tickets to the event. So if you guys are sitting there looking at that website, or it's getting jammed or blocked up or whatever, just keep trying and refreshing it. We get absolutely smacked with ticket sales when we do them at this price, because we just don't do them at this price very often. So keep working on it, keep grabbing the tickets, and Dave and I will keep answering some questions as we bounce along as well. I've just had an interesting one actually going on about that Wellington property market moving along, and saying, how long is it going to last for, all this sort of stuff. And just like yourself, my crystal ball's broken too. But to be fair, I'm looking at 7-8 years of pent up demand, and 7-8 years of people that haven't been able to afford to, or haven't bought a property, and all this sort of thing. And I did three auctions today, and one was for a little 2-bedroom flat in Nainai that went for nearly mid-3s, which is just obscene. And one which we actually bought was a good 3-bedroom villa in a great street in Petone. We had to pay a mid-6 for that one. The market's moving, but for every house we see sell, we see one person buy the house and 10 people behind them went to the open home, put in an offer, went to the auction, put an offer in at the tender or whatever, and they're distraught that they didn't get to buy the house, and they'll pay more next time. And that's the start of the greed factor, I suppose, that pushes all great markets along. And Auckland's had this for years. The media is just starting to pick it up in the other places as well. And long may it last, I reckon. Brilliant. With first home buyers facing the big leap to get into the home, isn't there a big opportunity in rent to own options or similar? Oh, Brian. I'm not a huge fan. How about yourself, Dave? Rent to buy? No. I could go on and on about why.
Look, I guess I've got a skeptical view because of past experiences, and we go back to when they were flooding around 2006, 7, 8, and they were almost kind of set up to fail, and most of them did, and people who engaged with them quite often were quite rawly ripped off. The biggest problem with rent to own is setting them up in a way that allows the purchase to take place, and setting them up in a way that makes it bankable later for the purchasers or the tenants. That's the hard bit, and it can be done. Pretty tricky.
Yep, I agree. And they're either too leveraged in one direction or too leveraged in the other, and somebody always feels, how do I explain this? I'll just say what I thought, butthurt about it at some point through the transaction, to be fair. One of the questions I'm getting quite a bit is a lot of people have got equity because obviously we're pretty top-heavy in Auckland property investors on the webinar tonight. A lot of people have got a lot of equity, but they're struggling with the income, the serviceability piece. Is there any real tricks to that, or do you just basically shop it around?
www.mortgagesupply.co.nz. It is where the key. This is the key thing. It's the one thing I think that we do better than most is unlock equity, because it's the income piece, and how the banks calculate it is wildly different. And we're transacting so many deals all of the time. We really do know how to get that equity out, and there's lots of different ways of doing it. And more often than not, it's going to involve changing your bank, because if you're dealing with one of the big boys, the ANZs, the Westpacs, their income calculations are pretty harsh compared to some of the other options. And I had a deal today where we looked at trying to get it done with the current bank. Happened to be ANZ. I'm not picking on them, it's just a coincidence. But the clients, according to ANZ's math, couldn't afford what they currently had. We were able to look at the numbers with so if they talk to ANZ right now, ANZ would be going, how did you get this approved in the first place? We then redid the numbers with TSB, found we could work the refinance and go and get them another 150k. So the gap is, and the big thing is that the more debt you have, the bigger this income calculation gap widens. The numbers keep getting wider. So, if you've got 5, 6, 7 properties in a portfolio and the debt associated with that, your borrowing capacity will vary wildly from one bank at the top of the scale to one bank at the bottom. It really will. And getting things looked at and reviewed is the first step in making your next purchase.
Yeah, absolutely. That's magic. Vlad's asked what time's the event start. It's an 8:30 registration with a 9 o'clock start time for both events in both Auckland and Wellington. And what do we got? 9 more ticket sales have just gone, so we're getting through them again. Another question there from William. What's that URL again? It's on the screen. It should be on the screen right now. Bookthedeal.co.nz. There's a little video there with me on it. And talks about the event a little bit, and you can book straight from there. Another quick question here from Geraldine is, are you coming to Christchurch? Not on this occasion, I'm afraid, no. We won't be doing a Christchurch event, but a lot of clients actually do fly into either Auckland or Wellington, make a weekend of it, come to our event, and get a lot of mileage out of that as well. It's just not that expensive just to travel these days, to be fair. All right, awesome. Sophie asked if we're doing a Christchurch event as well. Same answer. And so does Josh. Is there anybody here who's not from Christchurch? Okay, what else we got? What's the likeliness of interest rates rising all of a sudden? Wow. Over to you, Dave.
Hot potato. Based on all the feedback we're getting from, let's say, it's always good to blame the economists because they're always the ones that put around their opinions on interest rates. But most indications are that it's going to stay pretty flat for a while.
Yeah, I agree.
I was talking to clients in January about rates, and my kind of thoughts then was that the rates at the end of the year are going to be pretty much what they are now at the start of the year, and I can't see that changing much. So I think you've got a good couple of years where the rates are going to stay pretty low and fantastically low. I mean, you look at the rate options you get now, it's like going to a good restaurant, looking at the menu, and you can't decide what to eat because it all looks so good. I mean, the same can be said of our interest rates between floating and 5 years. There's not much between them, and they're all good options. So cash flow is going to be good.
I agree. Grant says, Steve, did you say that Auckland market grew at 17% per year over the last few years? No, I said it grew at 17% in the last 12 months, although it's flattened out slightly in the last couple of months. Says, and that isn't likely to slow down in the next few years. I don't have enough of a crystal ball for the Auckland market to tell you what it's going to happen in the next few years. All I can say is a lot of people have made a lot of money recently. I got a question here. Do you guys do one-on-one coaching or seminars only? Great question, Emma. Grab a ticket, come along to the event. We'll explain it to you. That's all I can say. Oh, interesting question here. Julian says, websites asking for credit card details over a non-encrypted line. If you have a problem with booking on bookthedeal.co.nz, just chuck a question in here on the questions section of the webinar software and just leave your email address and we will telesell you tomorrow sometime. We'll give you a quick call and we'll make a ticket booking for you then. We'll even take cash on the day, but we just want to make sure we reserve your seat because the Langham Hotel in Auckland and the Intercontinental in Wellington are big hotels with big rooms in them, but we try and give you plenty of space in the room and not cram anybody in. And so we do sell out pretty much every time we do one of these events. And so we really want to make sure you do get your ticket. So if you have a problem with booking it online, don't have a credit card, don't want to give us your credit card details, anything like that, then just give us your email address and say, hey, I want X number of tickets, and we will give you a call and make sure that we get it nailed and sorted out for you. So yeah, great question. That's brilliant. If me and my business partner have two houses between us and we live in one each, will they both be owner-occupied? Well, yeah, I'd imagine so. Dave, answer Mike's question. Will they both be owner-occupied? Yeah, they're both occupied by somebody who owns them.
Primary dwelling for each. Yeah.
Cool.
I'll tell you, an interesting one for guys is when you've got a home and income. So with a home and income, the banks have chosen to interpret that kind of property type in different ways. So it's almost a 50-50 split between them as to which ones will give you 80% and which ones will give you 70%. So there are some banks who will still only give you 70% on a home and income. A genuine home and income, you're living in the main part, you're renting out the minor dwelling, they're only going to 70%. So there are other banks who will give you 80 for exactly the same property. They're just both interpreting the Reserve Bank LVR rules slightly differently.
Yep. Got a question here. Do you lift? No, I'm actually naturally built this way. I'm presuming you mean wait or pick you up and bring you to the event. I don't know. Clarify your question a little. I'll come back with a better answer. There's a couple of people now chiming in. Christchurch. Yeah, I know. We really should do a Christchurch event. It's a bit wrong that we don't. We're not ignoring you. We're really not. Is the Wellington market suitable for trade or buy and hold? Is there capital growth in Wellington? Oh, look, capital growth was named after Wellington. It's the capital city. I'm entirely one-eyed. I really am. But I've got to say that the peak's been come off the Auckland market slightly. It's still rampant. There's still loads of money to be made in Auckland, but Wellington has just started to move, and it's moving because of a whole pile of key indicators and things that are actually happening that aren't going to go away in a great rush, like availability of money, confidence, business confidence. People don't buy a house or pay big rent or agree to pay a big rent on a 12-month term for a property if they think they're going to lose their job. There's so many people in Wellington now don't think they're going to lose their job particularly, and all of this stuff is starting to roll through really nicely. And I don't think that's going to change in a great rush. I really don't. So if you want to get into the property market at the moment, do. Get into the market that inspires you, gets you excited, that you really like. I think Wellington's a great bet at the moment, and I'm going to do a couple more webinars in the next couple of weeks and tell you why. If you want to log on to those, then just keep an eye on our Facebook page, and we'll keep bringing them to you. It's magic. But I don't think there's any right or wrong way to do it. I think if you bring the right funding to the right property, with the right funded mentors, and also with the right setup and attitude for your portfolio at the time, it's actually a little bit hard to go wrong at the moment. Obviously, I say that with the usual massive disclaimer. So there we go. Question here saying, I seem to have been charged twice. That means you've bought 2 tickets. You can bring 4 people. Yes! We'll sort that out. Don't panic. We will make sure that you get your refund if you don't want all of those tickets. Does the Wellington market growth include Hutt Valley, Petone, Javel? Yeah, it does. There's a lot of actual infrastructure going on, Brian, and I'll cover that in an upcoming webinar. I'm thinking, and love to hear your guys' opinion on this, but I might do a webinar in a couple of weeks' time with a couple of property investors, one from Auckland, one from Wellington, that are doing really, really well. And then I might do a third one a week or so after that, just talking about the Wellington market specifically. So I'll bring you some more stuff on that. But certainly, Johnsonville being a gateway road, awesome. Petone has just gone nuts lately. I've seen maybe 3 or 4 really nice properties, admittedly, but still 3 or 4 properties sell in the Petone market recently that have been north of $800,000, and really $600,000, $650,000 for a half decent little house is standard now. So yeah, I'll bring you some more stuff on that very shortly. Daryl's given me his email address for tickets on the Auckland event on the 15th of May, sorry. And yes, we will get in touch with you very shortly and make sure you get those tickets sorted out. Dave, can you please explain further cross-collateralization? Why use 2 banks? What's the big issue?
Yeah, no, great question to revisit. So, when a bank's link securities and hook them together, at some point you may want to sell one or other of those properties, and the bank has control over the release of that mortgage, has control over how much you might have to pay them back. And you just don't want to be in that situation as an investor, particularly if you have, a large number of properties, and even more so if one of those properties in the mix is your home. You know, imagine a situation where you've got 4 properties with one bank. You want to buy the 5th property, and that bank says no. It's a lot to unhook. And you know, if you've got rental properties hooked in with your home, so they're cross-securitized with your home, and let's say you've got $2 million worth of investment lending, and you've got 500,000 over your home's actually exposed to $2.5 million worth of debt. So if something goes wrong in your investment world, your home is part of the mix. And, you know, it's just sound practice to keep these things separate. And I think even more so for property investors as they go down the pathway of building a portfolio is you do want a situation where you're kind of the puppeteer, that you're the puppet master, and that you have control over your banks. And, you know, if you've got one bank over your home and other banks over your rental properties, well, Bank A is always going to want the business that Bank B's got, and Bank B wants the business that Bank A has got, and they actually keep treating you nice.
Yeah.
A common story for us is with people who've got all their business with one bank, and they don't kind of give them the love anymore, and you've got to treat them mean to keep them keen.
Yep. No, I love it. And I mean, in all reality, you know, banks are a business like anybody else. They're just working on market share, and they've got to work on profitability as well, the same as we do with any property we purchase. You just got to make smart moves about where you offer the finance, what you take it from, and where you go. You know.
Yep. And the more options you've got in play, the better.
Is commercial property a completely different market? Yes, it is. I was having this discussion with a client just very recently, actually, about a commercial property, Dave. Great question. Residential property is about core fundamentals in regards to location, asset class, capital gain versus cash flow, etc., like that. Commercial property tends to move a lot slower, but you also tend to spend a lot more money on it. It tends to be a higher priced item. But commercial property is realistically all about contracts. It's about valuations and leases, income versus asset cost. The analogy I used is if you go to an auction and watch somebody buy a residential house, they bid the price up. So you offer 600, then you go 610, then you go 620. In commercial property, they kind of look at it a very different way. If you ever go to a commercial property auction, a lot of people will be standing there with pen and paper or with a calculator, and they'll be bidding the yield down. And so what they do is they go, okay, I'm offering you $600,000 for that property because I know that it will rent for $60,000 a year, and that's a 10% return. Then somebody else offers 620, and the 10% return becomes 9.7. And they're actually bidding the cash flow down as the price goes up, and that's the way they look at it. And so what they're in fact saying when you get down to the nuts and bolts and really think about it is they're going, I'm willing to invest this much money in this location for a certain return. Whereas with residential property, they're looking at it as more of a liquid investment, something you buy into and then get out of on a more regular basis. So it is very, very different. But, you know, great question there. Is it possible to refinance away from one bank, ANZ for instance, if they have your home and a few IPs cross-securitized? Good question, Ben. Dave, you're away.
Yep. So they've got the home and there's a few investment properties, yeah.
Yep, with one bank.
Yep. Yeah, very much. So in that sort of situation, let's say we had a home and 3 rental properties. We're either going to move the rentals from the home and leave that with ANZ, or the other way around. And it really depends on the numbers. So it depends on the equity piece, and it also depends on what's the most cost-effective move, because some of those loans could have fixed rates. We're always mindful of break costs. We need to make it worthwhile. So what we tend to do is try and load up the rentals if we've got a way of doing that. So shift as much debt as we can to the rentals. Hopefully that creates some equity in the home that we can leverage, and then split them apart.
Yeah, magic. and really it's just about doing it smartly so that the investor doesn't get painted into a corner with any one particular bank, isn't it? I suppose that's the piece, isn't it?
Yeah,
Magic.
absolutely, and certainly with it, it's tended to be with someone like ANZ that not only can we go, okay, we can move that business there and move this business there. It's not just about making the split take place. It's actually make the split takes place and go, here's your pre-approval, because quite often ANZ have already said no, but other banks will say yes. So we tidy it all up and deliver back to you a pre-approval. If the numbers work, we'll get the numbers to work and get the pre-approval underway.
Yep, absolutely. Maria asks, I'm booking tickets for the Wellington seminar. If I put my name on all the tickets, can I pass them on as a gift? Yes, you absolutely can. Love you to do that. It'd be an interesting and good, valuable gift, I'm sure, as an education for somebody who wants to get into property. The only thing I'd say, Maria, is give us the names, email address, and phone number of the people you're actually gifting them to as well, because you'll have noticed when you register for the webinar tonight that we ask for a cell phone number. And the reason we do that is we actually send out a text reminder to remind you that the webinar tonight's on, and we do very similar stuff to make sure that you remember to come to the event itself as well. So give us the details of the person who's actually buying the ticket. We'll make sure that they get the correct reminders. Got some tickets coming out for Daryl, who's given me his details online here as well. I've been asked a question by Adam, how often would you sell a rental? If it's in your long-term portfolio and you like it and it's working for you, I would never sell it. Let them take it out of your cold, dead hands. That would be my advice, to be fair. We'll call you tomorrow, re-tickets. That's Ben saying, we'll call you tomorrow, David, meaning you, Mr. Windler. So there we go. He's going to give you a key.
Look forward to the call.
Excellent. Can I book 2 tickets under these names? Yep. And we will sort that out for you. Done. Thank you for that email address. How do you classify property improvement and maintenance costs for your tax return? Great question, Alice. I'm not even going to throw this one at Dave because he's going to flounder as well. I'm going to say exactly what I think, which is go to your accountant and get them to make a ruling on it for a couple of reasons. Firstly, I might be wrong and you can't sue me. But if you ask your accountant and they're wrong, it gives you some protection from Inland Revenue. And that's what you want. So ask the exact question in writing on an email to your accountant and get them to come back to you with an answer, which means that you've made the best attempt to get good qualified advice. And even if they're right, then great. And if they're wrong, at that point, you've actually taken advice from somebody. That's not my speciality field, and I don't think it's Dave Windler's speciality field, but it is nevertheless actually quite a great question. And we've got one of the best property accountants in the country coming to both of our events too, so you can always pitch the question to them at the event as well. One more email address, 2 more tickets. So we're out at about 40 tickets sold right now. And Clifton has asked for a couple more tickets to his email address. Bang, I will fire those out to you. I've got a guy working on the tickets in the background, actually, guys, so I'll probably make sure that we get something to you tonight. If not, it'll be first thing in the morning. Thank you so much for that. When do you get to use ResiMax to get a loan? So I think the question here, Dave, from Isako is, apologies if I've just absolutely murdered the pronunciation of your name, by the way. But I think the question is, what's the best use of ResiMax as a lender?
Definitely a kind of a medium to long-term proposition. They can go to a 90% loan-to-value ratio, 90% LVR, with what they call a prime product. So, you're going to have to prove your income in the same sort of way as you might if you were dealing with a bank. So they're pretty good for first home buyers if they're not quite up to scratch to get that lending through a bank, but really good for a buy and hold where the cash flow on the property is good, your own personal income position's pretty strong, but you're really short of equity because you only need a 10% deposit.
Yeah. No, good answer.
If you're looking to buy in, well, it's a 20% beat. You beat the bank by 20%. That's a lot of that's a lot of deposit that you don't have to come up with.
Yeah, magic. No, and I think that it's a good question and it's a good answer, but I think holistically the answer should be, hey, if you want to be active in this property market, go and sit down with Dave or one of his guys and explain
For
your
sure.
situation in detail, what it is that you're trying to achieve, and have them come up with not only a solution for the next purchase, but the next couple after that, so that you never lose that momentum. Because I've said it in the past and I mean it, is that the greatest tool that we have as property investors is our ability to borrow money, because being a cash buyer just puts you ahead of so many of the other muppets in the marketplace who are putting in conditional offers, or I've got to sell my house first, or I need 10 days to go. I haven't even seen a broker yet. I haven't got anything set up. And you know, bowl into Dave's office and say, hey, Dave, what do I need? And he'll give you a list and say, look, go and prove this, go and prove that, value that, bring me the financial accounts, or bring us your payment slips and blah, blah, blah. And you come back to him with all the right and the correct information. And he goes out there then and goes, right, this is what this buyer is trying to achieve. This is the best bank to put it with. Let's get a pre-approval moving along. And then you're actually, you're actually firing with all guns blazing out there in the marketplace, and you know what you can spend. And you know that you can spend it. You know that you can back yourself when it comes to, particularly in this marketplace where prices are moving and nobody knows what something's going to sell for. So they tender it or they auction it. And so you can't just poke an offer at it and hope you get it. You've actually got to be an unconditional buyer. I think that's really important. And I think that's where Dave and his team, and in particular the broker network that's turned up in New Zealand in the last 10, 15 years, has just made a massive difference to the property market, made it so much easier, because they'll do all the work for you. Geez, they do a heck of a lot of work in the background. So yeah,
yeah, we do it for nothing most of the time. So no, it's certainly for anyone who's listening who wants to to take a look at things, just hop onto the website. We've got a contact form. That form always comes to me. We'll get in touch with you, and it'd be a pleasure to help you out.
Yeah, actually, what is your website these days, so that I can send it out to everybody?
Yeah, sure. www.mortgagesupply.co.nz.
Mortgagesupply.co.nz. www.mortgagesupply.co.nz. All right, just sent it to everybody. If everybody's got on the chat room side of the software there, you've just been sent all of that. 2 more tickets there. Just got a text come through saying we've just hit 45 ticket sales. A couple of people have got multiple attempts at getting tickets because the website's still backed up a little, so we're bouncing a few, but we will make sure that we get those. Make sure we get you sorted out. Matt just asked if he could send him an email with his ticket confirmation. Yes, we will do. We've got your email address and your phone number there. Thanks so much for that. Will Resimac do 90% outside of Auckland? David asks.
Yep. So they'll do 90% in the main centres. So once you get a bit rural, if you like, with Resimac, they like to go down to slightly lower LVRs. But if you're talking main centre, as we've talked about tonight, Wellington, Hamilton, Tauranga, etc., 90%, no problem.
Yeah, great. Which shouldn't be a problem because we've been ranting a bit for years about making sure that people stay in at least 2 cow towns. Wow. I listen back to these recordings of these webinars sometimes and go, I wonder if there was anybody online tonight that I didn't offend. If you live in owner-occupied property and planning to buy another property, which you'll then live in and make the existing property a rental, there's always that question, isn't there? How do you use the equity in your existing home and keep the loan separate with different banks? Geraldine asks.
All right, so we've got our owner-occupied home, leverage that up to 80%.
Yep, and use the equity to buy another owner-occupier.
Yep, so you would probably, it's a hard one, because you need to have a little time lag between the two.
Yeah, but I've spoken to accountants and in particular Matt Gilligan about exactly this question, and it is doable though, isn't it? It's basically the answer, I suppose, isn't it?
Yeah, it is doable, because at no point in time with the bank that you're dealing with are you actually breaking the LVR rules. So when you apply to Bank A over your current home and ask for 80%, you're asking for 80% on an owner-occupied home. Then when you go to Bank B to buy your new home, you're not breaking the LVR rule there either.
No. Interesting, eh?
It is.
You came very close to telling people how to break the rules then, didn't you, Dave? You know it.
I try not to.
Is there 95% loan available for Wellington properties?
You aren't going to see that a bank advertise that anywhere, but if you're an extremely strong borrower and you wanted to do 95% on an owner-occupied home, then, that's possible. And, given that there's a 15% speed limit outside of Auckland, it's probably potentially possible on a rental property, but you'd have to be a really strong borrower.
Yep. Two other things too. Vendor finance, you get 100% sometimes, but you may have to pay more for the actual asset itself. And the other thing that I would say is if you're in a position where you only have a 5% deposit, are you buying the right house? Are you buying something that's actually got some equity in it that you can use later on? Why do you need to borrow 95%? If you have nothing to put into this property or very, very little to put into the property, maybe you've got to take a close look at why it is you're buying it, for what reason and how, all that type of thing. I think it's an important question to ask yourself as well. Just a thought. Cool. All right, so look, booking there. Still got more tickets coming through. All right, that's awesome. Look, I'm going to leave this up for another 20 or 30 minutes, but I'm going to profusely thank my co-presenter this evening, Mr. Dave Windler from the Mortgage Supply Company. Quick round of applause, everybody. Golf clap.
Pleasure.
Really appreciate the effort you put in to give us, let's face it, a few slides that are clear and concise and actually clear a lot of this stuff up. I would implore anybody else that's online, still 120 people online tonight, throw your questions through. I'll answer a few more if I possibly can. But grab your ticket to come along to the event, ask more questions. Ask more questions of Dave, myself, Sean, our crew at the event. Absorb all the information you possibly can. And we'd really, really like to see you at the event. Obviously, it's bookthedeal.co.nz. We've still got a few tickets trickling in there. Karen's just grabbed a ticket. So has another Maria. Sent me an email address, so I'll get those tickets out to you very quickly. Look, thanks so much for joining us tonight. We'll do a couple more of these quick webinars in the coming weeks. Come up with some awesome questions. Come up with some curly, tricky ones. Always love those. And look, I want to thank you guys so much for joining us on the webinar this evening. Really, really appreciate it. Grab those last few remaining tickets, and we will see you at the live events, both in Auckland and in Wellington. Awesome. All right. Thank you, guys. Have a great evening. Good night.
Thanks, everyone.